Good morning, everyone, and welcome to the Nutmeg webinar. I'm Claire from our Advice and Guidance team, and today I'll be joined by Dana Morgan and Andrew Lee, our Senior Wealth Managers, who will be telling you about 5 retirement savings strategies. We expect the webinar to take around 30 minutes for the content, and then there'll be some time at the end for questions. We've also got some QR codes throughout the presentation, so please feel free to use these to book a call with the team for some more in-depth discussions around your own circumstances. But first, just some important points to cover. We've assumed a basic knowledge of investing and pensions for this webinar, and everything we cover today is general information based on current legislation. It's not based on individual circumstances, which will vary, as will tax treatment. So it's always worth getting some individual advice or guidance from an expert to really understand how things apply to you. As with all investing, your capital is at risk, and that means the value of your portfolio can go down as well as up, and you may get back less than you invest. For personalised advice tailored to your specific situation around tax, you should consult with a qualified tax advisor or financial planner. So with that covered, I will hand over to Dana, who will take you through the first part of the presentation. If you've got questions as you go, then use the Q&A boxes at the bottom and we'll come back to them at the end of the session. Over to you, Dana.
Thank you, Claire, and good morning, everyone. So yeah, as Claire mentioned, we'll be looking at 5 retirement saving strategies today. And typically we associate pensions with retirement, and there's very good reason for that, given the tax benefits. So first of all, we'll be looking at how to make the most of your pension contributions with tax relief. And this is essentially a government incentive to save into your pension, and the potential tax relief you receive is based on your highest marginal income tax rate. Then we'll be looking at investment growth. Do you know how your pension is invested? Typically, for the majority of workplace pensions, your pension contributions are added into a default investment fund. Now, this may or may not be suitable for you based on your time horizon or your retirement choice. If it's not, it can have an impact on your final pension pot value. And you may therefore need to consider choosing an alternative investment or fund for your pension. Looking at how to keep a track of your pensions. Do you have a lost pension treasure, perhaps an old workplace pension? We'll look at how you can track these pots down and how you can allocate those to set yourself up for retirement success. And our final 2 points will be covered by Andrew, looking at how the most successful retirees have a range of savings and investment products to utilise for tax efficiency both now and in retirement. We'll look at those choices and how you can take advantage of them. Finally, looking at cash, and cash is always going to be needed as part of your complete asset portfolio, but how you can make the most of your interest and your cash savings and beyond. So if you do have that retirement dream or thought of what your retirement may look like, whether it be an earlier than expected finish or a once in a lifetime holiday, then little changes along the way can help boost your pension pot and help you achieve retirement success. So why do we invest? Well, when we look at a range of assets over a period of time, it can highlight the reason and the theory for investing. First, we look at how cash has performed over a 10-year period. And yes, we have been through a sustained period of low interest rates before they did start to rise in 2022. But when we do compare holding your money in cash as compared to inflation, it does really highlight that there is risk in taking no investment risk at all with your savings. Whilst there's always the risk of investment loss, over the long run, inflation will erode the real value of your cash savings. But of course, you always will need to have cash for something like a 6-month emergency cash fund. But investing your money, especially for a long period, has historically always outperformed your cash holdings. With Nutmeg's investments, they are made up of a range of global stocks and bonds. And when we speak about bonds, these are government debt and large corporation debt. They're seen as a relatively safer asset compared to the stock market. As for example, the UK government has never defaulted on a loan. They are traded on the secondary market, so are subject to market movements. And for example, we had the infamous Liz Truss mini budget in 2022. Of course, when we think about investing, we think more so about global stocks and individual companies, but we can see that is the most volatile line. So it does have those higher swings, ups and downs, but over the period has produced the highest returns. And I mean, we can clearly see that notable event in 2020, which you might have guessed is when the COVID lockdown happened. But even with pandemics, recessions, and wars, the stock market has historically always hit new highs. So when we think about pensions, we think that associate them along with retirement. And pensions are a valuable saving tool when it comes to successful retirement planning. The 3 points we'll cover for pensions is tax relief, investment growth, and how to keep track. So the rate of tax relief you receive will be based upon the rate of tax you pay. Looking at the graph and thinking about your earnings should help you identify your tax band. In the UK, we have marginal income tax rates. So we pay no income tax on the first £12,570 of our earnings, and this is known as your personal allowance. From there, we pay a basic rate of 20% till just over £50,000. The higher rate tax of 40% applies to income till £125,140, and then the 45% rate applies on any further income. By paying into a pension, it effectively reduces your income in the eyes of HMRC. So, for example, if you are paying a 40% income tax, by paying into a pension, you're able to benefit from a 40% income tax relief. If you can afford to, by paying into a pension, you are able to move into the next band down. There is, however, a 60% marginal income tax rate, and this applies when your income is between £100,000 and £125,140. So this can be seen as a fortunate position to be in, but it can also be a very nasty tax band. So when you are within this range of income, you do effectively have a further incentive to pay into your pension. Now, this marginal tax rate is applied as for every £2 of income you earn over 100,000, your personal allowance is withdrawn by £1. So if you are within this band, you tend to be subject to a higher tax rate, but contributing to your pension, as we know, reduces your income in the eyes of HMRC, so it can reinstate your personal allowance. Well, what does tax relief look like when you are paying into a personal pension? Well, a payment into your pension will go further than you first thought. If you're a basic rate taxpayer, an £80 contribution will total to a £100 contribution overall. So a 20% uplift will be added to your pension by the government. If you're a higher rate taxpayer or an additional rate taxpayer, you could be due further tax relief. And that'll either be at a further 20% or a further 25%. So that £80 contribution has actually now only cost you £60 or £55. At Nutmeg, we would reclaim that basic rate of tax on behalf of you and add that into your pension on top of your contribution. If you're a higher rate or an additional rate taxpayer, that further relief does need to be reclaimed via a self-assessment. You can claim this year and 3 previous tax years if you have paid into the pension as well. Your relief will typically be supplied as a rebate, and that could be either a reduction to any further tax liability or a change to your tax code. Now, there are limits on how much you can pay into a pension, and these are set on an annual allowance. So the annual allowance is capped at either the lower of 100% of your earnings or £60,000. If you are a non-earner or thinking about a non-earning partner, you are able to still benefit from tax relief. This limit is set to £3,600. So that would mean a £2,880 payment into a pension. The 20% would be reclaimed and uplifted to a total gross contribution of £3,600. High earners, you may be restricted how much you can pay into a pension on an annual basis. and this is due to the tapered annual allowance. So when your income starts to exceed 200,000, you may find your pension contributions can be restricted. This is due to the fact that for every £2 over your adjusted income, £1 of that annual allowance is reduced. Now, this can become quite slightly technical. So if you would like to discuss your own situation, myself and my team would be more than happy to discuss this in more detail. We can help clarify any pension rules that may affect you. We offer free financial guidance and are always here to help. So just scan that QR code. You are able to carry forward any unused allowances from 3 previous tax years, and this can make up for any lost years of sheltering and contributions. So how would carry forward work? Well, first of all, you do need to know your annual allowance for this tax year and 3 previous years. The pension annual allowance did increase from £40,000 to £60,000 in the tax year 23-24, so do be mindful of that. If you're a high earner, it's also worth double checking that the tapered annual allowance rules in those relevant years, as they have also been subject to change. To use carry forward, you must have utilised this year's allowance first. You're then able to go back to the earliest tax year. So in this example, if we're looking at the current tax year of 24-25, we've utilised the full allowance of £60,000. In the tax year 21-22, we've paid in £30,000 where the annual allowance was 40. 22-23, we did the same with a further £30,000. And last year, there was a £40,000 payment into your pension. So that would actually give us a further £40,000 of available allowance to pay into a pension, maximise those contributions, get tax relief, and also have that growing in a tax-free environment. Now, did you know if you are a limited company owner, you are also able to pay employer contributions into a personal pension? The benefit of doing so is that your company will save corporation tax as well as national insurance. This is because employer contributions are treated as an allowable expense, and it therefore reduces your company's corporation tax liability. You can make both one-off individual payments into a pension and also ad hoc lump sums. Our clients at Nutmeg, who are limited business owners, do like taking advantage of this. They may either do monthly payments to help with their cash flow, or you can make ad hoc lump sums into your pension, like via your company's year end. Now, looking at the investment performance in a pension, have you ever thought about where your pension is invested? Did you know you have the choice of how your pension is invested? Taking an interest is not just going to be beneficial for the pension and how hard it's working, it can also significantly affect your retirement success too. When we look at a compound growth calculator and compare a 4% and a 7% growth for investments over a 10, 20 and 30-year period, we can see that the difference and the rate of return is significantly higher when the growth rate is higher. Highlighting that, yes, of course, a 10-year time frame can make a difference, but the longer we have, the greater the impact on that overall pension pot and the retirement pot. So whilst those who are very close to retirement may not be solely focused on high growth and taking on more risk, those where retirement may seem like a distance in the future do have a one key advantage, which is time. When we're looking at this compound growth calculator, we're assuming a 4% and a 7% growth rate year after year. But if only it was ever that simple. So return rates are typically not consistent and they may vary each year. You should be able to look at your current pension investments and make changes dependent on your provider. Typically, a workplace pension will have a default investment to try and suit everyone involved in the scheme. But in reality, trying to find an approach for a young career starter compared to someone in their 50s is going to be a difficult and should be necessarily a different approach. So it is important to consider your own risk appetite, and your own time frame for your own pension investments. Now, I'm sure if we could all simply choose a growth rate and log into our pension accounts and investment accounts and select that 7% growth rate, I'm sure we all would. But do remember, with potential higher returns do come with a higher level of risk. And when we speak about risk at Nutmeg, we base this upon the makeup of your investments and those underlying assets. By that, I mean the proportion which is invested in stocks, which are riskier, and bonds, which are generally carry less risk. And that was shown at the beginning of this presentation. What the right risk level for you is going to largely extend to how long you have to be investing for, and how you want that approach and the market volatility and your experience of investing as well. But when we talk about market volatility, for example, if you were due to retire in 2020, and that was just before the COVID lockdown and the market impact in March, you would have seen a greater loss in your pension if you're in a higher risk investment fund than you would have experienced if you were in that more medium balanced approach. But part of the Nutmeg onboarding experience, we ask you a series of risk questions, and that helps determine your risk profile. So this is based upon the suitability for you, knowing your investment experience, your tolerance for risk, and also looking at your time horizon. Your wealth manager can also discuss this with you. So keeping track of pensions is going to be a vital part of your retirement strategy. It is estimated that there's over 26 billion lost in pensions in the UK. When the CEBR asked, more than 22% believe they've lost a pension pot. The problem's actually only getting bigger. So if you think about your own personal circumstances, have you changed jobs over the years? Have you moved houses, changed phone numbers, email addresses? If these providers are unable to contact you, they're unable to reach out to the owner, and hence this pension lost treasure is only actually getting bigger in the UK. There is a government pension tracing service which may be able to help you locate lost and any dormant pensions. To not become another statistic, you are able to consolidate existing pensions, and you are, for example, able to transfer into a Nutmeg personal pension. But why choose Nutmeg? Well, by consolidating your pensions, your administration burden will be eased. There's less providers for you to keep up to date with, whether that be contact numbers, phone number changes, home addresses, even surname changes. So always do consider when you are looking at consolidating your pensions to check any exit fees or guarantees which may be associated with those current providers. At Nutmeg, you're able to speak with a dedicated wealth manager, such as myself and my colleagues. We're able to give you guidance and help you understand and utilize your pension allowances. Discuss your current options, such as your pension investments, and finding that right risk level for yourself. All of that can help you achieve your retirement goals and your retirement dreams. You're able to speak to us as a new client and also throughout the lifetime relationship you can have at Nutmeg. And that's all included within the Nutmeg service. So with Nutmeg, you're able to choose an investment portfolio suitable for you and, of course, with your right suitable risk level. And as we have seen in the previous slide, that risk level and that investment choice can make a huge difference to your investment growth and your retirement pot. Nutmeg's investments are managed by a team of investment specialists, and our portfolios have global diversification at the very core of the philosophy at Nutmeg. These managed portfolios are monitored by our in-house investment team, and strategic changes are made based on market and economic data. So you don't need to be monitoring these markets. You don't need to be an investment expert. This can all be taken care of when you are investing with Nutmeg. And of course, there's support provided along the way. There's updates and communication, and you do feel empowered and confident about your investment decisions right through the very journey which you have with Nutmeg. If your Nutmeg portfolio does increase above a certain size, your fees do start to decrease. So Nutmeg's fee is based on a tiered fee system. So when a Nutmeg portfolio starts to exceed £100,000, your fee can start to be reduced. Having everything in one place allows you to take stock of your current pensions, and this can help you become retirement ready. In the Nutmeg app, we have a pension projection tool, which is built in to help you easily view your future forecasting with the current figures and your current pension portfolio. Thank you, everyone. We'll be looking at pensions, and I'm now going to hand it over to Andrew for our final 2 points.
Thanks, Dana. Pensions aren't the only way to set yourself up for retirement success, however. Having the flexibility to utilize a range of products available to you can be an effective way of investing and saving to grow your retirement pot. At Nutmeg, we offer multiple investment products, each with their own benefits. These products can be used in collaboration with each other to help you achieve your financial goals. The first of these is the Stocks and Shares Individual Savings Account, commonly referred to as an ISA. A Stocks and Shares ISA is an investment account with which you have a £20,000 annual allowance that resets every tax year on April 6th. The great thing when using a Stocks and Shares ISA is that your investment gains, as well as any income received, such as interest and dividends, can accumulate, grow, and then eventually be withdrawn completely tax-free. Another type of ISA available is the Lifetime ISA, or LISA. Lifetime ISAs can be opened by those between the ages of 18 to 39 and contributed up until the age of 50, with the purpose of saving for a first property or a further way of funding retirement. You can contribute up to £4,000 a year of your £20,000 annual ISA allowance up until you reach the age of 50. The interesting thing about LISAs is that the government will give you a 25% bonus on contributions, which is a potential £1,000 free money every year. Our general investment account is also a great option once your ISA allowance has been utilized. You're able to invest your money with no limit on how much you can contribute. However, the account may be subject to tax. Finally, our personal pension is beneficial in aiding retirement. Pensions are tax efficient as you will receive tax relief at your highest marginal income rate of tax, as Dana highlighted earlier. Investments within a pension are also tax-free. You may be able to consolidate previous or existing workplace pensions, as well as other SIPs or personal pensions that you hold elsewhere with Nutmeg. My final point today is regarding your cash savings. Cash is included when we think about your overall assets and should be used for an emergency fund, as well as for any spending plans for the next 3 years. We can still make the most of this cash, though, even without investing it. Seeking a high interest account that can make those cash savings work hard, there are some accounts that offer competitive interest rates on savings and rewards for spending. Chase, like Nutmeg, is part of the JP Morgan family and can give you visibility on your investments through the Chase banking app. I also wanted to make you aware that Nutmeg currently have a pension transfer promotion running. If you transfer at least £5,000 in existing pensions to Nutmeg, you can choose to receive a cash investment boost or Avios points as a reward. You need to have initiated any transfers before the end of the day on the 30th of November 2024 in order to be eligible. You can scan the QR code here to register for the offer. We hope you found today's session useful. If you would like to speak to us, you're able to book a meeting with one of our Wealth Services team using the QR code shown on screen. We can help you with the success strategies discussed today to ensure you get the most out of your tax-free allowances, whether that be using a pension or an ISA. In having that conversation with us, you can take stock of your current savings and investments and get on track for retirement whilst exploring different options. Nutmeg has various investment styles available across the investment products we've talked about today. We can help you to understand which one could be best for you, as well as the right risk level to help you achieve your retirement goal and set yourself up for retirement success. We also offer paid financial advice for those looking for a tailored financial plan to follow, and we can talk through this if this could be the right option for you. Thanks again all for attending. We will now open up for Q&A.
Thanks, Andrew. Thanks, Dana. So we've got a few questions, so I'll go through them now. So Dana, first one for you. You covered the £60,000 per annum contribution limit. Is there a separate limit between employer and employee contributions, and how is this split?
Thanks for the question. So that £60,000 annual allowance is your total annual allowance. So that is the employee and the employer as one. So, if you've paid in £30,000, the employer can pay in £30,000 as well. So that's the total annual allowance between the two of you.
Okay, and that's changed. Did you cover the fact that that's changed as well, the annual allowance?
Yeah, so it was £40,000
Right.
2 tax years ago. Yeah, so £60,000 this current tax year and the previous year as well. But if you do have, if you do want to maximise those annual allowances, as mentioned, you are able to carry forward unused allowances from previous years as well. So it may be worth looking at how much yourself and your employer has paid in previous years.
Okay, thank you. Andrew, one for you. What are the nutmeg fees?
So the nutmeg fees across the 4 more active investing styles, it's 0.75% for the nutmeg management fee for the first £100,000, and then 0.35% for any portion beyond. There's also a high net worth fee when you reach £500,000 of a flat 0.3 for the investment management fee. For fixed allocation, which is effectively kind of more low intervention, low cost, it's then 0.45% up to the 100,000, and then 0.25% for any portion beyond for the investment management fee. There are also fees for the actual underlying fund costs, as well as the market spread. You can view this on the Nutmeg website under investment styles and our fee, and there's also a handy calculator you can use to plug in the amount you're looking to invest, and it will let you know exactly percentage-wise and in sort of pound terms what the estimated cost of investing over the next 12 months would be.
Great, thank you. And then linked to, you mentioned fixed allocation. Someone else has asked whether we have passive funds. So can you just expand on fixed allocation a little bit?
Yeah, absolutely. So yeah, fixed allocation is our passive investment style option. It's more low intervention than the other active investing styles, where the Nutmeg investment management team makes the investment decisions and then seeks to rebalance based on sort of the risk level to keep you in line with your goals. They will make changes based on sort of sometimes broader events, but otherwise they look to sort of make kind of active invest decisions less frequently in the portfolio than across the other investment styles that we offer.
Okay. Another one for you, Dana. So we've got somebody who's given an example of when they take an income from their pension, after they've taken their 25% tax-free cash, they'll have 12,570 as taxable income, but they'll have no other income. So that is within their personal allowance. So what tax would they pay on that?
So if their total income is under the £12,570, then effectively there's no income tax to pay on that band of income. It is worth noting, like your pension is also your state pension can also be taxable income. If you are in receipt of that, that can pretty much take up the majority of your personal allowance. But if your sole income is just your private pension, which is under 12,570 in your personal allowance, then there'll be no income tax to pay for that year.
Okay, thank you. A question on the £100,000 tiering. So, Dana, maybe if you can cover this. Does the £100,000 mean the whole portfolio or per individual pot?
So it'll be based upon your entire portfolio. So when your Nutmeg portfolio starts to exceed £100,000, we will drop Nutmeg's fee down from 0.75% down to 0.35%. And that's on that proportion over 100,000. You would need to have your entire portfolio in the managed accounts. So we've got a range of managed investments at Nutmeg. And if it's all within a managed investment style, the 0.35% reduced fee will apply on the excess of £100,000. But we don't segregate between ISAs and pensions. We look at your total Nutmeg portfolio for you to benefit from that reduced fee.
Okay, great, thanks. We've had a couple of questions about whether people will get a copy of the recording. Yes, when you've registered, if you've opted in to receive communications, and you will get a copy of the recording afterwards. A question on what to do when both annual allowances of ISA and pension are used up and you still have cash to invest.
Yeah, I can take that. That's as I kind of mentioned in the presentation, the general investment account can be a great option for that if those are funds that you're looking to invest, if those are funds that you're potentially looking to more readily use as far as spending or for an emergency fund. Those could be something you keep in cash. And as mentioned, try to look for a high sort of a high interest or kind of reward that you might be able to get on those funds. But otherwise, the general investment account with Nutmeg is a great option, and you'll have the same investment styles available to you that you would across the pension and there's ISA.
Okay, thanks. And can you just expand, Andrew, on an emergency fund? Dana mentioned it at the start. So what would you say people should think about in terms of having some cash? Like, what's a reasonable sort of amount to hold as an emergency fund?
So typically it would be sort of 3 years of spending. So if you had any kind of emergency around, losing your job or any kind of external issue where you might need cash more readily that you don't want then subject to market forces, that would be an appropriate level. But there's not kind of an appropriate level for everyone across the board, as people's expenditure is always different.
Okay, thank you. Dana, I'll come to you for this one. What protection is offered when you go beyond the standard FSCS protection?
Thanks. So all Nutmeg's clients' investments and client cash is held within separate custodians and separate depositories from Nutmeg, and of course JP Morgan being backed by JP Morgan backed Nutmeg as well. So all clients' investments are held with a custodian called State Street, and cash is also held with Barclays as well. You know, in that very unlikely event that Nutmeg or JP Morgan was to go bankrupt, clients' money cannot be used for any liquidators or debtors. So there is that higher protection when you're investing with investment platforms, and of course, you know, investing with Nutmeg as well. So client money is held in completely separate separate accounts to business money as well there.
Okay, thanks, Dana. Another one for you, Dana. I only have rental and investment income. Is it still worth setting up a pension? I'm 56.
So of course, it's always going to be determined by your own individual circumstances, thinking how long you want to be investing for within a pension. But having rental income and any income which isn't necessarily taxable, you are able to benefit from tax relief pretty much instantly when you do pay into a pension. You're able to get that money back, which is always going to be great. Money in a pension and your investments are tax-free, so there's no tax on any capital gains you might make in a pension, and also any income you receive from things like dividends on your investments as well. If you're 56, that money in the pension, you may not be retired for another 65 till 65, 67 plus. So in that case as well, that money can be invested for 10, 12 plus years. So, there is always going to be benefits, typically when you are paying into a pension at any age, especially with tax relief and the tax wrapping protection within a pension as well. We can speak to you about that more personal circumstances as well by booking a call.
Sure. And the second part of that question actually was, how do I do this? So I think if a person asks that question, like, feel free to book a call in. And someone's mentioned that they can't scan the QR code because they're not haven't got a phone on them. So if that is the case, then we will, if you've flagged it in the chat, we will follow up with you, but you can also book a call by going to the Nutmeg website. There's a book a call link on there. Next question, is there a time limit to leave funds in a pension? Could you contribute 1 year and take out the following? Andrew, if you want to pick that one up.
So there isn't any sort of specific time limit of when you need to keep the funds in the pension. However, something to think about is that when you do make withdrawals from the pension, it can impact sort of your ability to make future contributions. You also could sort of be impacted taxably, but yeah, no kind of no sort of minimum time to then keep the funds of the pension, so long you're of sort of the age to be able to access the funds at pension age. So what will be 57 by 2028.
Okay, thanks, Andrew. So a couple of questions on this topic, so I'll try and group them together. But when you come to take an income from your pension when you start drawdown, does that mean you can't make any more contributions? And people asking whether there's a different annual allowance once you're retired. So Dana, are you happy to pick that one up?
Yeah, sure. So you can receive tax relief on paying into a pension up to the age of 75. But you may be restricted on how much you can pay into a pension. You know, if you have retired or if you've gone semi-retired and then just gone into part-time work. So your annual allowance, even though you may see that headline figure of £60,000, if your income is less than that, so for example, 20,000, you may be restricted on only paying £20,000 into the pension. Now, when they talk about your minimum 100% of your earnings or £60,000, there's also something known as your relevant earnings. So that is typically salaried income. If you're receiving like a state pension or taking drawdown from your private pension, or even things like benefits, they do not necessarily come into a relevant earnings in the eyes of HMRC. So, of course, you can still pay into your pension up to the age of 75, but you may be restricted based upon your relevant earnings. So it's worth double checking before you do make any pension contributions as well. If none of your earnings are relevant, there is still that £3,600 you can pay into your pension, that £2,880 as mentioned in the session as well. So few things to have a think about, but you are still able to pay into the pension.
Yeah, and then if you've taken an income from your pension, you're limited to the money purchased annual allowance as well, aren't you, in terms of making a payment into a pension once you've withdrawn income. So again, it's another situation where it's well worth getting some guidance or advice before you make that decision to take some income from your pension. If you've just taken tax-free cash, then it's not limited, but if you've taken income, then you'd be limited by that money purchase annual allowance, which is £10,000. I'm just going to check whether there's anything else. Can you transfer in a cash ISA? Andrew, do you want to take that one?
Yeah, absolutely. Yeah, you absolutely can. So at Nutmeg, we don't offer cash ISAs. However, you are able to transfer a cash ISA into one of our stocks and shares ISAs. If you'd like to then invest those funds within one of the investment styles, you absolutely can do so. If you wanted to keep all or a portion of that in cash, we do have cash pots available for that, where you then have the functionality if you'd like to then drip those funds from cash into one of the investment styles over time.
Okay, thank you. Just to follow up on the answer to the emergency fund, someone's asked whether 3 years worth of savings for an emergency fund. So I think, just to clarify on that, probably what we'd say is think about 6 months worth of savings for emergency funds. But if you've got goals that are within the next 3 years, then it's probably not something that you should be investing that money for. So just a bit of clarification on that answer. Just due to the volatility that you might experience if you need to take that money out within a 3-year time period. Can the 25% tax-free sum be taken over a number of years, and what happens if the whole fund grows? Dana, do you want to take that one?
Yeah, sure. So you're able to take up to 25% from your pension in a tax-free way, up to the lump sum allowance, which is just over £1 million. You can decide when and how much you want to take from that pot, so you don't have to take the full 25% out in one go. Typically what they'll do is they'll be like, what's the best way to describe this? there'll be a percentage amount of how much you have taken. So if that pot, does still grow, you're only able to take 25% from the lump sum allowance, which is just over £1 million. So yeah, I mean, you are able to take the half. You're able to take as much as you part of it as you like. Yeah.
Yeah, you don't need to take it all in one go. You can stagger it and take it over time. Okay, we've probably got time for a couple more. So one for you, Andrew. Are there any fees involved in changing your portfolio's risk level?
No. So no specific fees across the fees for Nutmeg. The actual market spread, which across the investment styles is 0.04%. That takes into consideration both changes in sort of the investment styles, and then also sort of just the ongoing investment management. So no additional kind of specific fee. It's still within sort of the all-encompassing percentage fee for Nutmeg.
Okay, thank you. And then we've got one about, can you explain how an actively managed pension works? How active is it? For example, if you had an actively managed pension prior to COVID, would the allocation have been changed against the COVID downturn? Andrew, do you want to have a go at that one?
Yeah, sure. So effectively the sort of the active investing styles for Nutmeg are looked at on a day-to-day, week-to-week, month-to-month basis. The investment days are typically Mondays and Thursdays. You can always see within your Nutmeg account on transactions all the different sort of investments, whether rebalancing or kind of active investment decisions made by the Nutmeg investment management team, to get sort of a kind of an idea and sort of full transparency for how active your funds are actually being invested. Depending on sort of the investment team's outlook and view for a period, as you mentioned, during COVID, there would have been ideally then some sort of active investing changes made in order to kind of have the portfolio perform as well as it could have. But really with Nutmeg portfolios, they are well diversified both globally and across different sort of investments, whether it be stocks, industries, and different sort of asset classes. So the goal is that the portfolio is a little bit more kind of all weather to be able to deal with those kind of unforeseen situations like COVID, but that there is the active piece, so they can make investment decisions on the go and hopefully kind of benefit when there are chances to, similar to when there was just the market correction with the change in sort of the Bank of Japan interest rate and the yen.
Okay, thank you. One final question: can that 3,600 personal contribution for non-earners be carried forward 3 years if previously missed?
Take that one. So unfortunately it can't be carried forward from previous years. You have to utilise the full £60,000 to be able to use carry forward. Okay.
All right, I think that probably brings us to the end of the webinar. Thanks everybody, thanks for all the questions. Any that we haven't covered live, if you've given us your contact details, we'll follow up with you afterwards and try and make sure that we answer your question. And do feel free to book a call for anybody who wants a more in-depth discussion. Thanks everyone.